Every monetary crisis follows the same pattern. First, the crash that makes everyone believe the system is working. Then, the realizations that the crash was the signal the system was breaking. Today's brutal sell-off in gold and silver wasn't market forces finding equilibrium. It wasn't profit-taking by rational investors. It wasn't technical correction after extended rally. Today was systematic destruction of price discovery. Coordinated attack on precious metals designed to shake out weak hands before the real monetary crisis begins. And if you interpreted today's crash as evidence that gold and silver are overvalued, you missed the most important signal markets have sent in decades. The signal that paper markets and physical markets are now operating in completely different realities. The price discovery mechanisms are breaking down under the weight of political intervention. That the final phase of monetary crisis has begun, and the crash was just the opening move. Because crashes in precious metals markets don't happen because precious metals become less valuable. They happen because someone with enough firepower decides precious metals are becoming too valuable too quickly. And when someone with that kind of firepower starts attacking precious metals prices, it means precious metals are approaching levels that threaten the stability of paper currency systems. Today's crash wasn't the end of the precious metals bull market. It was confirmation that we're entering the final phase. The phase where paper promises break down completely and only physical assets retain value. But to understand why today's crash was a buy signal rather than a sell signal, we need to understand how precious metals markets actually work when monetary systems approach their mathematical limits. Because what you witness today isn't normal market behavior, it's crisis market behavior. And crisis markets follow different rules than normal markets. Normal markets respond to supply and demand fundamentals. Crisis markets respond to survival instincts and political calculations. Today's sell-off had nothing to do with silver supply increasing or gold demand decreasing. Today's sell-off had everything to do with political authority, recognizing that precious metals prices were approaching levels that expose the weakness of fiat currency systems. When gold approaches $5,000 per ounce, it forces uncomfortable questions about why governments need to create trillions in new currency every year. When silver breaks $150 per ounce, it highlights how much purchasing power paper money has lost over the last 50 years. These questions become dangerous when asked by mainstream investors rather than just precious metals enthusiasts. Dangerous enough to warrant coordinated intervention designed to crash prices before broader public understanding develops. But intervention in precious metals markets carries its own risks. Because when prices are artificially suppressed through paper market manipulation, physical markets begin operating according to different mathematics. And those different mathematics eventually overwhelm paper market control. This is what makes today's crash so significant, not because it proves precious metals were overvalued, but because it demonstrates the lengths political authority will go to maintain control over precious metals pricing. And desperate measures reveal desperation. When central banks and exchange operators coordinate margin hikes, futures dumping, and systematic liquidation to crash precious metals prices, they're not responding to market fundamentals. They're responding to political necessity. The political necessity of preventing precious metals from reaching levels that completely discredit fiat currency systems. But political necessity has mathematical limits, and those limits are now visible in precious metals markets. Consider what actually happened during today's sell-off. Silver dropped from $128 to $106 in approximately 4 hours. Gold fell from $4,200 to $3,800 over the same period. That's not gradual price adjustment based on changing fundamentals. That's systematic dumping of paper contracts designed to trigger algorithmic selling and forced liquidation. When you dump that volume of paper silver and paper gold into futures markets in compressed time frames, you create artificial supply that has nothing to do with physical metal availability. But artificial supply creates artificial prices. And artificial prices, when they diverge sufficiently from physical reality, eventually snap back toward physical reality, sometimes violently. The question isn't whether today's artificially suppressed prices will return to previous levels. The question is how much higher they'll go when the snapback occurs. Because snapbacks in precious metals, markets typically overshoot in the opposite direction by margins, exceeding the original manipulation. History provides extensive precedent for this pattern. Every major precious metals crash engineered through paper market manipulation has been followed by rallies that exceeded previous highs by substantial margins. 1974 to 1975. Gold crashed from $195 to $103 through coordinated central bank selling and futures market intervention. The crash lasted 8 months and convinced most observers that the gold rally was over. Gold subsequently rose from $103 to $850 over the following 5 years, a gain of 825% that dwarfed the previous rally and established gold as the premier store of value during the 1970s inflation crisis. 1979 to 1980, Silver crashed from $49 to $11 when the COMEX changed margin requirements and restricted trading. The crash was so severe that the Hunt brothers, the largest silver investors in the world, were forced into bankruptcy. But the underlying monetary crisis that drove silver to $49 hadn't been resolved. It had been temporarily suppressed through market manipulation. When suppression ended, silver resumed its upward trajectory and established a base around $15 to $20 that persisted for decades. 2008, gold crashed from $1,033 to $681 during the Lehman Brothers collapse and subsequent deleveraging panic. Most observers interpreted the crash as evidence that gold was just another risk asset that declined during crisis periods. Gold subsequently doubled from its crash lows and established $2,000 as a psychological resistance level that would eventually become support during the next major monetary crisis. The pattern repeats because the underlying dynamics remain consistent. Precious metals crashes engineered through paper market manipulation don't resolve the fundamental monetary problems that drive precious metals higher. They temporarily suppress price signals while the fundamental problems worsen. When suppression ends, prices don't just return to previous levels. They advance to new levels that reflect the cumulative monetary damage that occurred during the suppression period. This is why today's crash should be interpreted as a buying signal rather than a selling signal. Because the monetary crisis that drove gold and silver to recent highs hasn't been resolved, it's been temporarily suppressed through coordinated market manipulation. And suppressed monetary crisis, like suppressed steam pressure, eventually finds release through whatever opening becomes available. In precious metals markets, that release typically manifests as rapid price appreciation that exceeds most investors' ability to respond. But there's another reason why today's crash represents a buying opportunity rather than a selling opportunity. The crash revealed something crucial about the structure of precious metals markets that most people don't understand. The crash revealed the extent to which precious metals prices are controlled by paper contracts rather than physical supply and demand. When silver can drop $22 in 4 hours without any change in physical supply or physical demand, it demonstrates that paper silver trading dominates actual silver trading. And paper silver trading operates according to financial engineering rather than silver fundamentals. Financial engineering can create artificial scarcity or artificial abundance in paper markets. But financial engineering cannot create actual silver. It cannot increase mining output. It cannot reduce industrial consumption. It cannot change the physical reality that silver supply is limited while silver demand continues expanding. Today's crash was financial engineering. But financial engineering, however sophisticated, eventually encounters physical reality. And physical reality doesn't respond to margin calls, algorithmic trading, or coordinated dumping. Physical reality responds to actual supply and actual demand. And actual supply and actual demand in silver markets point toward much higher prices, regardless of what happens in paper markets. Annual silver production remains approximately 1 billion ounces. Annual silver consumption exceeds 1 billion ounces. The deficit is filled from existing inventories that continue declining. COMEX registered silver inventories down 78% since 2020. The London Metal Exchange, silver stocks down 62% over the same period. Shanghai Futures Exchange, reporting delivery delays for the first time in institutional memory. Have you seen what's happening with silver prices? It looks like a crash, right? But what if I told you this isn't the end of the story? What if it's the beginning of something much, much bigger? Let's peel back the layers and look at what's really going on behind the scenes. You see, while the price on your screen, the paper price, is dropping, something incredible is happening in the real world. Industrial demand for physical silver is absolutely exploding. Think about it. Every electric vehicle rolling off the assembly line needs silver components. Every new solar panel being installed across the globe uses silver paste. The massive rollout of 5G infrastructure, that's powered by silver-intensive electronics. And the data centers that run our digital world, they're filled with silver-embedded components. These are fundamental real-world demands. They don't just vanish because a number on a screen changes. Industrial giants still need actual physical silver to build their products. Mining companies are still facing the hard realities of geology. They can't just magically produce more silver overnight. So what we have is a widening gap. The demand for physical silver is growing while the actual supply is struggling to keep up. Yet the paper price tells a story of abundance. It just doesn't add up. This strange situation, where the paper price is low but physical demand is high, creates a massive opportunity. It's like finding a rare collectible at a garage sale price. Right now, you can buy real tangible metal at the discounted paper price. But these kinds of opportunities in the precious metals market don't last forever. Something has to give. Either the paper price will eventually have to shoot up to reflect the real scarcity, or the physical silver will simply run out for sale at these prices. Looking at the current trends, dwindling inventories and skyrocketing demand, it's looking more and more likely that the physical availability is what will disappear first. And when you can no longer get your hands on the physical metal, the paper price becomes meaningless. What good is a paper promise for silver if there's no silver to deliver? This is the critical transition point that today's price drop might be signaling. We're not seeing the end of the silver story. We're re-seeing the shift from a market dominated by paper prices to one dictated by physical reality. Historically, when this kind of shift happens, it happens fast. It's like a dam breaking. One moment, everyone believes in the paper promises. The next, a wave of realization hits industrial consumers, big investors, and everyday buyers all at once. The paper can't be redeemed for the real thing. When that confidence shatters, people don't just gradually start buying physical metal. They panic. It becomes a frantic rush as everyone tries to secure what little physical silver is left, all at the same time. And in a panic, people don't care about chart patterns or waiting for the right price. They buy at whatever price they can, just to get their hands on it. This is why today's artificially low prices might be the last chance to get in before the real fireworks start. Once panic buying takes hold, it pushes prices to levels that seem impossible right now. We've seen it before. During the silver panic in the late 1970s, the price shot up from around $11 to nearly $50 in just 18 months. It wasn't because the fundamentals suddenly justified that price. It was pure panic. Demand simply overwhelmed the available supply at any sane price. Could we see something similar again? The potential is definitely there. With the current suppressed prices, a perfect storm of industrial demand, a potential monetary crisis, and global uncertainty could trigger a buying frenzy from all sides. Imagine silver not at $20 or $30, but at $300, $400, or even $500 an ounce. The math is startling. If you just look at the solar energy sector, a full transition to green energy could eat up all of the world's available silver within just 5 years. Now, add in the demand from electric vehicles, 5G, data centers, plus people buying it as a safe haven from economic turmoil. You quickly get to a scenario where demand outstrips the total silver being mined by 2, 3, or even 4 times. The possibility is real. The question is, will you be positioned before the panic begins? Thanks for watching. If you found this perspective valuable, make sure to like, subscribe, and hit that notification bell so you don't miss our next deep dive. When demand exceeds supply by those margins, prices don't rise gradually. They spike until demand destruction occurs or alternative supply sources emerge. Neither demand destruction nor alternative supply appears likely in silver markets. Industrial applications for silver are expanding rather than contracting. Mining output faces geological constraints that cannot be overcome through higher prices alone. This creates conditions where modest supply disruptions or modest demand increases could trigger price spikes that dwarf previous precious metals rallies. Today's crash, by artificially suppressing prices at the exact moment when fundamental supply and demand dynamics point toward much higher prices, may have created the perfect setup for such a spike. But recognizing the setup requires understanding that crashes in precious metals markets are often signals rather than conclusions. Signals that paper market manipulation has reached its limits. Signals that physical reality is preparing to assert dominance over financial engineering. Signals that the final phase of monetary crisis is beginning. And final phase dynamics in monetary crises don't follow normal market rules. They follow survival rules, where securing real assets matters more than optimizing entry prices, where physical possession trumps paper promises, where being early matters less than being positioned. Today's crash offered positioning opportunity. The question is whether you recognized it as opportunity rather than threat. Because when panic buying begins, when physical markets completely divorce from paper markets, when precious metals remember their role as monetary assets rather than trading vehicles, the opportunity to position disappears. What remains is the opportunity to observe others panic buying at prices that make today's crash levels appear extraordinarily generous. The crash was the signal, not the signal to sell, but the signal that the end game is approaching. And in the end game, paper prices become academic while physical possession becomes essential. Today's crash wasn't the end of anything. It was the beginning of everything. The beginning of the final phase where monetary crisis meets physical scarcity and produces price discovery that makes today's levels appear historical curiosity. But only for those who recognize the crash as signal rather than conclusion. The buying pandemonium is coming. Today's crash was the invitation. Whether you accepted the invitation depends on whether you understood what markets were actually telling you. They were telling you that paper control is breaking down, that physical reality is reasserting dominance, that precious metals are transitioning from financial instruments to monetary necessities. And monetary necessities don't trade, they accumulate, until there's nothing left to accumulate. And nothing left to accumulate means prices that reflect actual scarcity rather than paper abundance. The crash was the beginning. What comes next will make the crash appear insignificant. but only to those who positioned during the crash rather than panicking because of the crash. The signal was sent, the invitation was extended. The only question is whether you were listening